Today, we're embarking on a mission based on a really compelling analysis you shared with us. It's focused on SoundHound AI, ticker SOUN.
Right. A stock that has been, the definition of volatility lately.
Exactly. And the core thesis of this analysis we're looking at is that while the whole AI sector has been, reeling from a massive correction, this specific stock might have just hit a critical turning point.
Yeah, that volatility has definitely made a lot of investors think, maybe the party's over.
That the easy money's been made and things are winding down.
But this report, it argues the complete opposite. It suggests that this recent sharp price drop in SoundHound AI has actually presented a golden opportunity.
A chance to buy quality growth at a pretty big discount.
That's right. So we are going to dive deep into the technical, the psychological, and of course the fundamental arguments that this analysis presents.
So we're not just summarizing a headline.
No, not at all. We're unpacking why this analysis believes the recent price level, right around $10, is such a key entry point. We're going to look at the indicators right alongside the cold, hard facts of the company's financials.
And its position in the market.
Exactly. The central question this report explores, and really the question we want you to keep in mind, is whether all this intense volatility we've seen is it an ongoing risk to be avoided?
Or is it something else?
Or was it, a necessary fleshing out event that has now cleared the path for growth, making it a genuine gift for new investment capital?
Okay, let's unpack this. First, let's just define the dip that we're talking about here. The chart action has been, dramatic.
Dramatic is a good word for it. Yeah.
The report really focuses on this brutal retreat from highs that went over $20.
And then it just collapsed all the way down into that $9 to $10 range. That is a stomach-churning correction for anyone who got caught near the top.
But the volatility itself isn't the whole story, is it? It's the reaction to that volatility.
Right, that's the key signal.
The technical signal that really triggered this whole discussion was that forceful bounce. The stock recently closed at $10.60, seeing a really strong move of over 6% in just one session.
And crucially, on heavy volume.
On significantly increased volume. It bounced exactly where the report identifies this critical multi-month support zone.
And this is where we get to move beyond just, lines on a chart and start talking about human behavior.
Market psychology.
Precisely. The analysis places a huge emphasis on the significance of that $10 level itself.
Okay, so why $10? Why is that number so important?
Because it's not just a number, it's a powerful psychological floor. For a stock that flew above $20, $10 represents a clean 50% retracement.
It's a round number. People anchor to it.
A massive number of investors, both retail and institutional, anchor their decisions right there. The analysis points out that the specific low, where it hit 97 and just refused to break down,
it just held.
It suggests deep underlying institutional support stepped in right at that key figure.
So if the stock held that $10 floor, what does that imply about the state of the market, according to this report?
The report is very, very optimistic on this point. It suggests that the initial hype premium is completely gone.
Okay, so the frenzy is over.
Exactly. The report's thesis is that the frenzy that drove the stock up, fueled by general AI enthusiasm and all those headlines last year, it's evaporated.
You're no longer paying for the buzz.
You're paying for the tangible business itself. And when the price stabilized there, it signaled that the selling pressure was just exhausted.
The report uses a specific phrase for that, right?
Because it says the weak hands, as the market calls them, have finally sold out.
So the stock is now in stronger hands, people looking for actual fundamental value.
That's the idea.
But hold on a minute. If the sellers are truly exhausted, why is the stock still down more than 50% from its peak? Isn't that lingering volatility itself a huge risk that maybe the report is glossing over?
And that is the essential counter-argument we have to consider. The analysis doesn't deny that risk.
Okay.
But it argues that the risk is mitigated by the underlying financial stability of the company. And that brings us right to the fundamentals.
As you said, you don't buy a dip just because a chart looks stable.
Never.
Right.
You buy it because the underlying company is healthy and, more importantly, it's still growing.
So let's pivot to that health. The analysis paints a very reassuring picture of SoundHound's balance sheet. They even call it a cash fortress.
Which is a pretty strong term.
It is.
Yeah.
Specifically, the company is sitting on nearly $270 million in cash. And in this market, cash is definitely king.
And what makes that cash figure so impressive, especially for a growth company, is the other side of the balance sheet.
The liabilities.
Right. The analysis stresses the fact that SoundHound has almost zero debt.
And that's critical right now.
It is absolutely critical in today's, high interest rate environment. When capital is expensive, a company's ability to fund its own growth becomes its greatest competitive advantage.
So for you, the listener, what does that practically mean?
It means the company has what the report calls a bulletproof balance sheet. More crucially, that $270 million provides an enormous runway.
A runway to get to profitability.
Exactly. They have the internal resources to execute their growth plan without having to go back to the market and dilute shareholders.
Okay. For listeners who might not track financial statements every day, can we quickly define dilution here? Why does avoiding it matter so much?
Absolutely. So when a growth company runs low on cash, they often have to sell new stock to the public to raise money. That's dilution.
And if they do that when the stock price is low?
It's terrible for existing shareholders. If they do it at, say, $10, they have to issue millions of new shares, which immediately lowers the ownership stake and thus the value for everyone who already owns the stock.
So by having all that cash and no debt?
The report argues they can just ignore the short-term market noise. They can avoid that pressure entirely. This balance sheet stability is cited as the #1 factor protecting the downside risk at this $10 level.
Okay, so that's the defense. Let's talk offense. Here's where we move from the balance sheet to their actual market position.
And their product traction.
Right. The report argues SoundHound is far more than just some generic AI service. It explicitly counters this idea that they're just ChatGPT wrappers.
Which is a criticism you hear about a lot of AI companies.
A lot of them. But they back this up with hard performance data. The company just posted a record $42 million quarter.
And year over year, that's a massive number.
A massive 68% growth rate. This level of increase, according to the analysis, is what transitions them from being a concept stock,
you know, selling a future dream,
to a company that is cashing checks today based on real established enterprise contracts.
And those contracts are the true measure. The growth isn't just theoretical. The analysis specifically lists major automotive players, Hyundai, Stellantis,
which are embedding SoundHound's voice AI directly into their vehicles.
Right. But it's not just auto. They also cite huge consumer brands like White Castle and Jersey Mike's in the quick service restaurant space.
This immediately defines the growth trajectory, then.
It really does. In the auto world, this isn't just, turn on the radio. It's deep integration into navigation, climate control, all these future vehicle functions.
And in the fast food space.
That's the voice commerce revolution. Think about a future where drive-thrus are entirely managed by sophisticated AI that can handle complex, customized orders seamlessly.
That real-world application is fascinating. For the listener, what exactly does this voice commerce catalyst look like in practice? I mean, how is SoundHound's tech different from the simple voice assistants we already have in our cars or homes?
The analysis suggests the big differentiator is sophistication, but also independence.
Independent.
Yeah. SoundHound is positioned as the only independent player standing tall. That means they're not tied to Google or Apple or Amazon.
Which makes them really attractive to car manufacturers like Hyundai.
Of course. They don't want to hand over all their valuable customer data to their biggest competitors.
That makes perfect sense.
And for the drive-thru specifically, the tech is transactional. It's designed to handle noisy environments and complex language.
So it can understand a complicated order.
Exactly. It ensures that when you order a double cheeseburger with no pickle, extra ketchup, and a side of chili cheese fries, the system understands and processes that correctly every time.
And the report has a timeline for this.
It does. It predicts that voice commerce is set to fully permeate drive-thrus and cars starting as soon as 2026. That timeline defines the core growth catalyst.
So if they're already in with White Castle and Jersey Mike's, they're basically selling the infrastructure for the next generation of retail.
That's the long-term vision presented in the report.
Okay, so we have stabilizing price action, a cash-rich balance sheet, and exploding revenue from major enterprise contracts. What does all of this mean for the future valuation? Let's get into the analyst consensus and the all-important path to profitability.
Right. The numbers.
The analysis references the current consensus targets. So based on that recent 1060 close, the average consensus price target among analysts is currently $17.50.
That's a potential upside of about 65% from here.
A pretty significant upside. But the report goes further. It outlines what it calls the blue sky scenario.
And that blue sky scenario target, it goes up substantially, all the way to $27.
But that's not just a guess, right? It's tied to something specific.
It's not a hopeful guess at all. It's directly linked to the company hitting very specific profitability benchmarks.
And that's the challenge for any high-growth AI stock, isn't it? Translating that explosive revenue into actual profit.
It's the ultimate test. And that $27 target, it relies heavily on the company successfully reaching operational profitability in late 2026.
This brings us to the margin story. For listeners who might need a quick refresher, what exactly is gross margin? And why is the analysis so focused on its improvement?
So gross margin is basically the revenue left over after you subtract the direct costs of providing the service.
So the cost of servers, software licensing, that kind of thing.
Exactly. The staff needed to implement the tech. It's a crucial metric for efficiency.
And SoundHound's is improving.
Precisely. The analysis highlights that their gross margin story is improving rapidly. It's currently approaching 60%.
And for a company providing complex AI, 60% is a strong number.
It's a very strong signal. It means that as they scale up and get more contracts, their cost structure is becoming highly efficient.
And Wall Street loves that kind of story.
Oh, they love a turnaround profit story. Especially when a company can show expanding margins, because it makes that path to the 2026 goal much clearer. It makes it more predictable.
It shows the business model is inherently profitable at scale.
That's the bottom line.
Well, that analysis paints a really compelling picture. The conclusion is pretty clear. The stock is currently rated as a strong buy, according to the report we reviewed.
And it's all based on the belief that the market has just dramatically oversold this stock in the face of very strong fundamentals.
So let's bring this full circle to the analysis report's final verdict. It says the risk-to-reward ratio at the $10 level is, and I'm quoting here, fantastic.
And the argument rests on that $270 million in cash protecting the downside.
While the accelerating adoption in the AI sector fuels the massive upside potential. The report concludes that if that 2026 profitability timeline holds, SOUN at $10 is a steal.
It certainly provides an extremely bullish outlook. I mean, there's no denying that. However, that entire bullish thesis rests on two critical dependencies.
Okay, what are they?
First, that the market correctly values that margin expansion as the path to profit. And second, of course, the successful execution of those 2026 profitability targets.
Everything comes back to execution.
Always. We detailed the specific customers and the reliance on voice commerce adoption in restaurants and cars. So, here's the final thought for you to explore on your own.
Okay.
Given the entrenched habits of consumers and, the notoriously slow adoption cycles of major auto manufacturers, how quickly might voice commerce truly permeate those sectors?
Could that pace of adoption, either accelerating faster than predicted or maybe slowing down, significantly impact that crucial late 2026 profitability timeline?
And if it does, how does that shift the blue sky scenario we just discussed?
That is a great question, because at the end of the day, the pace of execution is the engine driving this entire valuation forecast. Thank you for joining us for this deep dive into the volatility and opportunity around SoundHound AI. We hope this gave you the comprehensive analysis you needed to understand the current narrative. We'll catch you on the next one.